Hey guys, Dave Keller here with Market Misbehavior. Today I'm going to share with you 3 stocks in 3 different phases. Now, when we talk about phases of different charts, this is a sort of approach that's been popularized by a number of different strategists over time. Stan Weinstein is often credited with what he calls the stage analysis, right? And sort of labeling stocks or bucketing stocks based on the different stages that they might be in, based on their trends, and really by using moving averages as a way to more systematize that approach. Many others have done that sort of thing. Craig Johnson, the team at Piper Sandler, started by Ed Nikoski years ago, sort of have a similar idea. I know other books have been written about bucketing stocks. And, I know from my time working in the institutional buy side, we would often sort of bucket charts into different categories. And we would often go with the good, the bad, and the neutral. Not the ugly, more the neutral, but it was sort of thumbs up, thumbs down, or thumbs sideways. And then we would go through the thumbs up pile. All right, what are the really, really good and what are the kind of good? All right, let's look at the thumbs down pile. Which are the obvious ignore? Which are the ones that may have some opportunity? Start to differentiate them. We would literally print out hundreds and hundreds of charts every time and get a big conference room table and start to bucket things based on those different criteria. The good news is in 2023, you have a lot of capabilities with websites like stockcharts.com and others to help you, bucket stocks based on different characteristics. And by using scanning engines, by using just a visual analysis and then starting to group stocks based on, where you put them in a chart list or how you, put them on different watch lists can really help you manage those ideas pretty well, I would say. What's interesting in 2023, I think for a lot of investors, this feels like a macro call, right? Do I want to own stocks or not? But what I like to remind people is in any environment, there are usually charts that are going up and there are charts that are going down. Now, in a downtrend, in a market correction, like I would argue we're still in, you have more down charts than up charts. That's fair. But even in a market that feels very homogenous, there are always stocks and groups and sectors that are differentiating from each other. So today I'm going to highlight 3 stocks, one going up, Alphabet, one clearly going down, Starbucks, and one going sideways, Tesla. And we'll talk about what allows us to put them in those buckets and talk about some of the specific levels and patterns we would be looking for here. Before we get to that message, a couple quick things. First off, it would do me such a big favor if you would like the video right now before we go any further. Awesome. Thanks so much for doing that. Also, subscribe to my channel. If you're finding this from somewhere else, go ahead and subscribe. I appreciate it very much. Drop a comment below. Which of these stocks do you see as the best opportunity in the next 4 to 6 weeks and why? Drop a comment, let me know. Before we get to the charts, here's one more thing I wanted to let you know about. Today's video is brought to you by Seeking Alpha. I'm a big fan of places that allow you to better understand the market environment. I think seekingalpha.com is certainly one of those. When you go to the website, I would check out the stock screener, particularly because it allows you to use Seeking Alpha's proprietary quant model. In my experience working with institutional investors, we always had what's called an alpha model or a quantitative model, which really modeled the characteristics of strong companies, demonstrating strong growth prospects and strong price momentum. Seeking Alpha does a really good job of taking that institutional level quantitative capability and putting it in the hands of individual investors. If you go to marketmisbehavior.com/seeking alpha or just click on the link in the description below, you can go right to a special offer. If you use the link, you get $50 off your first year and also get a 7-day free trial to check everything out. So go to marketmisbehavior.com/seeking alpha. Now back to the video. All right, so in terms of a chart going higher, Alphabet's one of those examples that just popped right out of my head. Alphabet and NVIDIA are sort of the 2 go-to uptrend stocks that I have in mind. There are others that are breaking out of broader bases, but charts like Alphabet are just in a nice, consistent uptrend. Now, what defines this chart as being in an uptrend, or why would I group it in what I call stocks in an accumulation phase, meaning an uptrend pattern? It starts with Charles Dow's original analysis of higher highs and higher lows are an uptrend. So if you look through the course of 2023, really starting in the 4th quarter of last year, we've had consistent higher highs, right? When Alphabet moves higher, has an upswing, it tends to eclipse the previous high. We often have these levels of resistance that are then broken. We saw one here in February, March, April, May is the breakout. Here, May, June, July, gap higher in July, holding that as support now for a couple months after that. So sort of a stepwise motion. Also look at the lows. So every time we pull back, we tend to make a higher low from the previous swing. Compare that to back here in 2022, where we have the opposite, a consistent pattern of lower lows and lower highs. So the fact that Charles Dow would say this is an uptrend is good enough for me, but let's get a little more granular with it. In particular, what's key about a chart like this is when you set a resistance level, like this was around 127 for Alphabet back here in May and June. Look at how many times we tested that, then we gapped above it, and then tested that level once again as support. And that's a technical concept called polarity, where a level of resistance becomes support, and also can be used inversely, where a level of support becomes a new level of resistance. Here, this becomes the new floor, and you can see pullbacks have found support right around at the same level. And once again, we're rotating higher. So we're making higher lows, and we're making potentially higher highs. So as long as that trend continues, we're in good shape. We are currently above two upward sloping moving averages. We're above the 50-day and we're above the 200-day. The RSI, my favorite measure of price momentum, is in the bullish range. So when a market is in an uptrend, the entire range of the RSI tends to push higher. In a downtrend, the entire range of the RSI moves lower. Look here in the first, I'll call it the half of the chart. On rallies, on these little price swings higher, the RSI rarely gets much above 60. And when we drop, it often gets down to that oversold region. So the whole range has kind of pushed down. Now compare that to 2023, where we often become overbought on upswings. When we pull back, the RSI doesn't get much below 40. So the fact that we're now in this new range for the RSI suggests we've gone from a distribution phase in 2022 to an accumulation phase of 2023. Now the strength in Alphabet is allowing this stock to outperform the S&P 500. So this is a simple ratio chart of Alphabet versus the SPY, and you can see that the line overall is trending higher. And that means, again, that it's doing better than the average stock or doing better than the benchmarks. So that's why Alphabet, I think, makes sense as sort of a classic uptrend phase or a classic accumulation phase, as I like to describe it. And what do you do with a name like this? I would argue you hold it until the trend changes, right? You assume that trends will persist. That's what John Murphy and Martin Pring taught me in the first couple books I ever read on technical analysis. That's what momentum or trend following style of investing is all based off of, the fact that trends tend to persist on this sort of time frame. So higher highs and higher lows above the moving averages, strong but not excessive momentum, improving relative strength. As long as I can still describe the chart of Alphabet in that way, I don't think there's any reason to change a bullish perspective. Now, let's talk about the second type of chart, the bad chart or the downtrend phase, right? So StarBucks is a good example of a stock that was in an accumulation phase, really in the second half of 2022 and even the first almost half of 2023. Look at how we made fairly consistent higher highs and higher lows, most recently making a new high at the end of April. From the beginning of May, though, we've sort of reversed, and you can see we've gone from higher lows to lower lows, from higher highs to lower highs. We've now gone from being above two upward sloping moving averages back here in January to now below two downward sloping moving averages here in October of 2023. The RSI now in the bearish range, so we're not getting up to the overbought region on rallies. We're stalling out around an RSI level of 60. And because we've been going lower, the momentum, the relative strength, looking at StarBucks versus the S&P from that May peak, StarBucks has been a pretty chronic underperformer. So overall, the trend is now down. I would argue this is a stock firmly in a distribution phase, and I would be inclined to avoid a chart like this until something changes, right? You wait for signs of accumulation. You wait for a sign of reversal. So what kind of things would we look for on this chart that could suggest that the downward phase is over? What you want to do is just start reversing all of the negative checks that you made on the list. Look for the opposite, right? So instead of making lower lows, we make a higher low. Instead of making lower highs, we make a higher high. Instead of being below two downward sloping moving averages, we start to break above moving averages and hold those breakouts. I drew a trend line from the May and August peaks. Getting above that trend line, which would be right around the 50-day moving average, that would be a nice development, just telling me that we've broken. This is the trend line that basically defines the pace of the downswing. Can we change that? Do we break above that trendline resistance? The RSI is firmly in the bearish range. Can we get back to the bullish range? Meaning on a rally, does the RSI get above 60? On a pullback, does the RSI hold above 40? Does the relative strength improve? All of those things would tell me that the chart of Starbucks is starting to go up. So when I think about a Starbucks or a Disney or a Paramount or any of those stocks that are in just consistent downtrends, in some ways, they're some of the easiest charts to understand, because all you need to do is wait for signs of accumulation, wait for something to change, wait for what I call a change of character that would tell us we're getting out of a distribution phase and into a more constructive technical configuration. Finally, we have the third bucket. I love to call this video the good, the bad, and the ugly. It's kind of a trite title, but this isn't an ugly chart. I would say this is the third option, which is what I call a consolidation phase, or a sideways market. Chart of Tesla and a couple others at here in October of 2023 are in a consolidation phase. So Tesla at this point over the last couple months is no longer going up, but it's not going down, right? The chart of Starbucks was in an uptrend and then was in a clear downtrend of lower highs and lower lows. If you look at Tesla, it was in an upswing for much of 2023. Now we're in a sideways phase of lower highs and higher lows. If you think about it, the midpoint or the median of this pattern is right around $250. So what's happening here, or 255 we'll call it. So basically what happened is in June, Tesla reached $255 a share. Then we overshot and undershot and overshot and undershot that equilibrium price, or that median price. So the triangle, or the coil pattern as we would call it, sort of centering around that median price. And all we're doing is basically over and undershooting about the fair value of Tesla, according to the market. What do you do in this sort of pattern? Well, here, you wait, you're patient, right? You hold, you sit on your hands and wait for a break. And by definition, this pattern does not tell you which way the break is going to occur. At some point, usually about 2/3 to 3/4 of the way through the pattern, we either break above the upper boundary or break below the lower boundary. And whichever way that chart breaks, that's usually the direction of momentum that you want to follow, because here the market is saying it's worth about 255. If we break above this pattern to the upside, that tells you that there's more buying power coming in. There's more demand for the stock, and investors are willing to pay a little bit more. So something's changed that's caused new buyers to come in, or new accumulation. On the other side, if we break below the lower boundary, that would tell you that all the buying's now been done, and now people are just sort of unwinding position. Maybe they're selling interest for some reason, but for whatever it is, this price is no longer the right valuation for the stock, according to the market. So chart like Tesla, it's a neutral, right? It's a wait. And you wait to see which way we break. Do we break above the upper boundary or below the lower boundary? One of those things is most likely to come pretty soon, probably in the month of October. So there you go. Those are three charts in three different phases. Alphabet in an accumulation phase, Starbucks in a distribution phase, Tesla in a sideways or consolidation phase. Which of those three charts do you have the highest conviction on? Drop a comment below. Let me know which one and why. For Market Misbehavior, I'm Dave Keller. Be well, stay safe, have a good one.